QuickBooks Pro Desktop 2021, reversing entry, accounts receivable, sales with the help of Excel. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars homepage. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. We're going to be opening up our financial statements. So let's go to the reports dropdown, company and financial, open up our balance sheet standard and set the date as of our cutoff date, 02/28/21. No, missed it. Hold on, missed the button here. 21. There we go. Let's open up our profit and loss. Go into the reports drop down, company and financial, on down to the P&L, profit and loss. That's right at the top, which is going to be from 01/01/21 to 02/28/21. And so here's going to be our profit and loss. Now, in the prior presentations, we were taking a look at an adjusting entry related to the accounts receivable. The bottom line of that, if we go back to the home page, is that this invoice, an invoice was entered after the cutoff date, March, even though the work was done before the cutoff date. In our case, the inventory was shipped out, we're saying, before the cutoff. Therefore, from an accrual basis, this is like a standard cutoff kind of thing that you might see if you work in auditing. You'll see this is like one of your testing things you'll have to do. But in any case, we brought it back into the current time period with an adjusting entry. So let's consider what that adjusting entry looked like in Excel, and then think about how we're going to put this into QuickBooks so that we can both make the financial statements correct as of a certain point in time, the cutoff date, and also not mess up the bookkeeping process as we move forward. So let's go back to Excel and see what we have so far. So this was our adjusting entry. So these are all the accounts that are affected when you make an invoice. So this is basically just us analyzing the invoice, seeing what the effect was, entering the exact transaction that is recorded to the accounts when entering an invoice, but doing it with a journal entry so that we can then enter it as of the cutoff date, pulling it back to the cutoff date. Now, you can see the problem here, of course, is that, well, if I do the same transaction before the cutoff date, then as of the date of the invoice, when it was entered, March 5th, it's going to be in there 2 times. So in other words, if I enter this transaction as we did into the QuickBooks file, it's correct as of the cutoff date, but then it'll be wrong as of the 5th of March. It'll be in there 2 times. So how can we solve that problem? Well, we can enter this in as we did with a journal entry, and then we can do a reversing entry so that it'll be correct in the next month and not be in there 2 times. And that'll make it correct as of the cutoff date, and it'll reverse it so we can get back to doing logistically what we did in the normal process, so it doesn't mess up the bookkeeper in any way going forward. So we entered this in last time. We're going to do the reversing entry, and the reversing entry would happen the day after the cutoff, right? Even though the invoice went into the system on the 5th day. So you might think, why don't I do the reversing entry on the 5th? Then it would be correct the whole time period, because if I put it in there as of the 1st day of March, then it'll be wrong until the invoice was actually input on the 5th day. But I don't really care that it's wrong for 5 days is the point, because we expect there's to be some problem on a perfect accrual basis method in the middle of the time period. We're trying to make it correct as of the cutoff dates, and I want to put all the reversing entries in there as of the same day so that when we look them up and find them, they're not scattered around the month, right? We want them all on one day so we can basically find what they are. All right, so we're going to do a reversing entry. We're going to say reverse number 4 here. Now, the reversing entry is easy once you know what the adjusting entry is. So, and if you're thinking about this, if you have like a test question on this, or if you're trying to just mull this over on what happened, what you want to do is think about what would an invoice do, and then reverse it. So if you're trying to reverse something, don't try to reconstruct a journal entry backwards in your mind. Instead, think about the forward journal entry, the normal journal entry, which means an invoice journal entry. If you create an invoice, in other words, you would debit the accounts receivable and increase the accounts receivable, increase sales, increase the sales tax. Then you would increase cost of goods sold and decrease inventory. And then simply reverse it line by line. Do not, or I would recommend do not, try to reformat your journal entry as you might see in a book problem, where you're going to try to put the debits on top when you reformat your journal entry. You don't need the debits on top. it's easier to see in the same format that you would write it down when you're going the normal direction. So when I go in the reverse direction, I'm not going to reverse the order of my accounts. I'm just going to say, all right, accounts receivable is going to be the first account, but instead of debiting it, I'm going to credit it. That's going to look funny because there's a credit on top, but it's not wrong. It's easier to see. So that's what I would do, right? And then we're going to be debiting sales. Now that should look funny because we don't normally debit sales. Sales only goes up in the credit direction, but it's a reversing entry, and reversing entries are just funny in and of themselves. So I'm just doing the exact opposite, same ordering of the account, just doing the exact opposite down here in terms of the journal entries. So there we have it, and so there we have it. So this is just an exact reversal of what we did up top. And so then if we were to record this, remember this transaction, this is our financial statements as of the cutoff date, 2/28. And then we're going to do adjustments for 3/1. This represents 3/1 if we were to think of the 3-month time period, January through 3/1, basically, including our reversing. And this would be just March, just the current month, to see what the effect of these transactions would be if we just looked at March. So let's consider this. Now, you might want to highlight these when you record them, because so I might say maybe this whole thing, I'm just going to say, let's do the whole thing. I'm going to make this green to say, hey, look, that's what I'm working on right now. And then I'm going to go to the accounts receivable. I'm going to say, all right, we're reversing that, taking it back down to 0. So it's correct as of the cutoff. Then it's going to go back down to what it was after the cutoff so that the normal timing difference can take place and it'll be correct on 3/5 when the actual inventory was entered. Then we have the sales is going to be down here. So sales is going to be equal to that 380. So it went up, and then we took it back out, and it's back down to what it was as of 3/1, the day after the cutoff. And then we have the sales tax. So sales tax, and where was that? Here. And notice I didn't add another sales tax payable, which we did in the QuickBooks system. So that could cause a problem when you line this up next time. We may have been better off creating another sales tax, so I'd have that sales tax 1 and sales tax 2. You'd like to have this matching exactly what is in the QuickBooks system as much as possible. So just realize that, but I'm not going to do it now. That's going to be the 19. So we increased it, then we took it back down. And then the cost of goods sold is going to be down here. So the cost of goods sold is going to be equal to the 304. So same scenario, we recorded it, increased in the cost of goods sold, took it back down, and then we have the inventory. So the inventory up top is going to be here. So I'm going to say this will be equal to the inventory, which is going to go back. So here we have the inventory going down to there. Now it goes back up. So there we have it. Now, if we're thinking about the 3-month time period down here on the income statement, this would be where we stand if we run the income statement, since it's all in the same year, from January up through March, just including these reversing entries in March, right? That's where we would stand. And then if we think about us closing out the income statement for the 2-month time period, January and February, into our equity section here, then this is going to be the activity that just would happen in March. So when I enter this into QuickBooks and I run the income statement for the 3-month time period, January through March, and March just including these reversing entries, we will run these numbers and we'll have this net income. If I was to run just March, closing out January and February to equity, and then run just March, we're gonna see these numbers. And so that should look kind of funny because sales here is actually a negative sales, and we've got negative cost of goods sold. That's going to be an effect of this reversing entry. These two are wrong, right? These are wrong. You don't have negative numbers on it, but they're only going to be wrong from January through the 5th. I'm sorry, from the 1st to the 5th, not January, March 1st to March 5th. Then when we enter the invoice, when the invoice was actually entered, these will be reversed out back to 0, because they really should be 0 because we pulled the income into the current time period into February. into February. So as of March, they should be 0. They're not 0 from March 1st to March 4th. They will be 0 by March 5th because that's when we actually entered the invoice in the system. So they'll reverse out. So that's going to be how our reversing entry happens. And that way, as we do these adjusting entries, we don't mess up anything that's going to happen on the bookkeeping side of things. We just tell them, hey, look, we're just going to enter the adjusting entry and the reversing entry. That makes everything correct. And then you don't have to do any changes to your invoice or anything. It'll be correct as of March 5th, and then going forward, it'll be correct basically periodically. Now, when we enter this into QuickBooks, we're going to have the same problems we had up top. The accounts receivable, we're going to need to make sure that we enter it along with the subledger of the customer. So we're going to have to enter that with a customer. The sales tax payable, we had that issue. I don't want to mess up the little widget that's used, so we actually made another sales tax payable so we can have an account just for our adjusting entry. And the inventory, you'll recall, was off before by our adjusting entry because our adjusting entry did not affect the actual inventory count, but only the GL accounts. Then we had a difference between our GL account and the subledger. When we reverse it, when we do our reversing entry, we'll be back in line. We'll line it back up. So that's what we'll do, and we'll enter this into QuickBooks. Next time, we'll take a look at those issues, and then we'll line up our numbers to what we can see here kind of more transparently in the Excel sheet. We'll line up and see where we stand. We'll be here as of the end of the cutoff, and then this will be for the 3 months ended, and then this will be just for March after our reversing entries, and then we'll see how these two accounts will match up to the invoice when the invoice was entered on March 5th.